Hi guys, and welcome to Investor's Guide to the Galaxy. It's your host Alex Ionescu. In Peter's Lynch One Up on Wall Street, he views investments in the stock market based on 6 types of companies. Let's dive right into it. First, let's see S&P 500. Today down 0.72%, year to date down almost 11%, past year down almost 3%. Who is Peter Lynch? Peter Lynch is a legendary value investor that has one of the best investing track records ever. He managed the Magellan Fund at Fidelity Investments between 1977 and 1990 and returned an average of 29% per year in those times. He views investments in the stock market based on 6 types of companies. First one is fast growers. The first type of company is called fast growers. Fast growers are companies that have proven to be able to grow their earnings per share by about 25% a year on average. The key to investing in this type of company is to be wary and exit when the growth rate slows down. The best kind of stocks for fast growers are those that are not owned by many institutions and are rarely heard, and they do not have a lot of analyst coverage yet. These kinds of companies tend to be underappreciated. From my experience, fast growers tend to sell at a premium. One thing that I look out for when analyzing fast growers is the PEG ratio. I use it when I look at fast growing company with a high PE ratio, price to earnings ratio. Simply put, PEG ratio is the PE ratio of the company over its EPS growth rate. So if a company has a PE ratio of 30, but its growth rate is 60%, its PEG ratio is less than 1, which may show that the company is undervalued relative to its growth rate, meaning that the valuation of the company may still seem okay even though its PE ratio is high relative to its growth rate. Second, slow growers. The opposite of fast growers is slow growers. Slow growers are companies that usually pay dividends. The best kind of dividend paying companies are those that pay dividends and the dividend grows constantly year over year. With this kind of dividend paying company, we should look at its payout ratio, which shows the percentage of its earnings paid out as dividends. More than 100% is a warning signal, as it will not be sustainable. Anything below 60% is conservative and more sustainable, in my opinion. Slow growers may be considered for income investors seeking stable dividend-paying investment. 3. Stalwarts. Stalwarts are somewhere in the middle of fast growers and slow growers. They no longer grow as fast as a fast grower, but also not as slow as a slow grower. Peter Lynch says that they are likely recession-proof companies. That means companies that possibly sell necessities like Unilever and Procter & Gamble. Dollar discount shops might also be recession-proof too, because in a recession people tend to be more budget conscious and shop more at discount stores. 4 is cyclical. Cyclical companies are companies with their profits moving up and down in cycles. It could be companies in the oil industry, as oil prices generally move up and down according to the supply and demand at the time. Memory prices are another example of a commodity that usually moves up and down in cycles. With cyclical companies, the trick is to know when to buy during the down cycle and exit during the up cycle. Personally, I made good money buying Micron, a cyclical memory company stock, some at $34 in 2019. When the cycle turns up, the stock price also goes up pretty fast. In the last memory cycle, Micron went up from 10% from $10 in 2016 swiftly to about $60 in 2018. But when it goes down, it also goes down fast. It went down from about $60 to about $30 in less than 6 months after that. As of 1st of February 2020, it is about $50. 5. Turnarounds are investment opportunity for companies that we think are currently in a bad position and is able to turn itself around. I think one such example of a company is Apple before Steve Jobs went back and took over as CEO. After his return, he introduced the legendary iPhone and many other innovative products like the iPod. For turnaround companies, the strength of the balance sheet is very important because they need to be able to get through the rough situation if there is any possibility of a turnaround. Asset plays, the sixth one, the last one. Peter Lynch says to look for assets of the company that are underappreciated by the market. The assets can be tangible or intangible assets. It is important to look at the strength of the balance sheet and whether the company is taking on too much debt that could potentially erode the value of the assets in the future. Disney, a long time ago, could be considered as an asset play type of situation because back then, Marvel, even though they own it, are still not monetized as well yet at that point in time. Other lessons that I took away from this book: put in the effort to learn as much as you can about the company before investing a dime. Put in at least 1 hour of investment research every week. Look for underappreciated companies that do not have a lot of analyst coverage yet. Do not invest in hot stocks in hot industries. Companies with no debt cannot go bankrupt. Companies with significant insider ownership is always a plus point. Good profits can be made by investing in the right turnaround companies. In which type of company did you invest till now? I'd like to know your opinion on this. Please leave a comment below. If you like this video, please smash that like button for the YouTube algorithm so that other people like you see this video. And don't forget to subscribe to my channel. Thank you very much. I appreciate all of you that watch my videos. See you next time.